All right. Good morning, everybody. Good morning. Good morning. Thank you so much for taking the time to join us. So my name is Steve Kass, and I'll be serving as the host and moderator today. And I'm joined by my colleagues Jon Moore, who is one of the founders of our company. Jon serves as our Chief Strategy Officer and General Counsel, and Eric Bratcher, who is our Chief Risk Officer, Chief Economist, and knower of all things related to energy markets. My only value here is I think I'm the only fiver who's actually been through the Strait of Hormuz during my active duty days in the Navy. I was on a destroyer that escorted tankers through the straits, and so I'm just here for comic relief. So let's hop into the agenda. We'll take a look at what we're gonna talk about today. Okay, so I'm going to start out with a quick little geography lesson around the Persian Gulf, share some fun facts about the region and why the Strait of Hormuz is pretty important. Um, Jon's going to talk about the geopolitics of what's happening in the region, and then Eric is going to chat about energy markets and how they are reacting both globally and domestically. And then we'll wrap up with a little bit of our advice and recommendations for energy buyers, given all that's happening. If you have any questions, please use your Q&A button. I'm going to try to stop at a couple of points throughout the webinar to answer any questions anybody might have. Okay, so first, let's go through a little bit of geography here. So what we're looking at here is a map of the Persian Gulf. Sometimes it's called the Arabian Gulf, but it is that body of water that sits between or among 8 neighboring Arab states that includes Oman, the UAE, Saudi Arabia, Qatar, Bahrain, Kuwait, Iran, and Iraq. At the northern end of the Gulf, Eric, can you move your pointer up to where you see Basra up there in the upper corner? Yeah, right there. So at the northern end, this is where the Tigris and the Euphrates River converge. And it exits, there's a little waterway called the Shat al-Arab River that dumps right into the Persian Gulf. It's actually the only source of fresh water the Gulf has. But this is a very strategic waterway. And anything stand out about the coastline of Iraq?
There's not much of it.
Yeah, exactly. There's only about 35 miles of coastline that Iraq has, where it gives access to the Persian Gulf. So that little waterway has been of strategic importance for the last 100 years, and actually forms a disputed border between the two nations of Iraq and Kuwait. And that's actually one of the reasons why the Iran-Iraq war started in 1980, among other reasons. But it's a pretty vital waterway that's of strategic importance. You can see the Persian Gulf is about 600 nautical miles long, around 200 nautical miles wide, and it's pretty shallow. It's no more than about 150 feet deep on average, and the weather is brutal. Seas are flat. There's very little wind. The sun is intense, and it's like living in a convection oven. It's a brutal place to operate. Towards the right side of that map, you can see the Strait of Hormuz, and that is where the Gulf empties into the Indian Ocean, and it's nestled between or separates the peninsula belonging to the UAE and Oman and Iran. So you go to the next slide, you'll see that this shows why this is of strategic importance. It is a very narrow body of water. At its narrowest point, it's around 20 nautical miles. And it's about 100 nautical miles to transit what we traditionally call the straits itself. You'll see one of the reasons this is of strategic importance, especially for the Navy, as you can see, there's only 20 nautical miles between that very tip and that island that sits there in the strait. That photo on the right is actually a picture I took from the bridge of the destroyer I served on. And you can see that we're escorting. You can see 3 tankers there on the left-hand side of the screen, and you can see, if you look closely, you can see the outline of a Perry-class frigate there to the starboard side. I'm sorry, the right side. But that's what makes this area very very intense, is when you're going through and you're escorting tankers out of the Gulf. you're not going any faster than the slowest tankers. That means we're transiting probably at 12 to 15 knots on average, and that's not a lot of time to react to a threat, whether it's from a missile attack or anything that may be coming at you. So today, it's a different kind of threat than when I was there, but it's still a very dangerous place to operate. The next slide shows graphically what has happened to maritime traffic after hostilities started on February 28th. And as you can see from this chart, it's not just oil and crude products that go through the strait. All kinds of different commercial traffic go through the Strait of Hormuz. And you can see it's pretty much ground to a halt since February 28th. So over the last 2.5 months, there's been very, very little commercial traffic at all flowing through the Strait of Hormuz. The next slide specifically looks at oil. So you can see the chart on the left looks at the number of millions of barrels of oil per day that flows through various choke points around the globe. And you can see that the Strait of Hormuz is second only to the Straits of Malacca in Indonesia in terms of the amount of oil that flows through that strait. But even at that, with 20 million barrels per day, that's twice as much as what goes through, more than twice as much as what goes through the Suez Canal, and over 10x of what flows through the Panama Canal. So clearly, a lot of global traffic of crude oil flows through that strait. On the other chart on the right, a couple of things stand out. First of all, this shows you that the U.S. is the global leader in liquefied natural gas exports, followed by Australia, but look who's number 3, Qatar. And that country's LNG export capacity was pretty much destroyed in the opening weeks of this conflict with Iran, which is going to have major implications and an effect for a while now. So this kind of sets the stage for where we are today. And John's going to walk us through some of the political risks.
Thanks, Steve. That's a great summary of the geography and the current situation on the ground or in the water or on the water of the Middle East. And I'm pretty sure I've listened to quite a few podcasts and presentations about the situation in the Middle East and the Strait of Hormuz, but I think Steve is the first time I've heard a panelist who's actually been through the straits, and I think he did it like a half a dozen times during various conflicts. I'll also know I've been working with Steve for like 25 years, and if I had to find anyone or pick anyone to take me through the Straits of Hormuz, I'd pick my friend Steve.
Thanks, John. Although I wouldn't sign up to go through it again, though.
Well,
let's go somewhere more fun.
Yeah, I think we could probably find someplace we'd prefer to travel together. Yeah. But anyway, just a note. Before turning to Eric Bratcher, who's going to talk to us a little bit about how the situation in the Middle East is impacting energy prices, I thought it might be helpful to try to put the situation, the energy market situation, in the context of the current geopolitical situation. When we're providing advice, on these webinars or one-on-one to clients about what's going to happen to the energy market, we generally understand at least the unknown factors that can move the market and by how much. For example, is the weather going to be hotter or colder? What's going on with supply? Have there been changes in demand? Or even if there's some kind of regulatory risk we're aware of out there, such as state or federal actions or changes to environmental regulations. But understanding, though, the traditional risks that move energy markets here in the U.S. is really not sufficient to understand what's going on in the Middle East. And I discussed this in a recent blog post and suggested that an old answer to a reporter's question by then Secretary of State Donald Rumsfeld might be a better way of thinking about risk in the Middle East. And it was a pretty confusing answer, and probably appropriate because the Middle East is pretty confusing. And Rumsfeld made this comment, and here's what he said. He said he talked about the Middle East in the terms of 3 categories of knowns: known knowns, known unknowns, and most importantly, and the one that confuses everyone, the unknown unknowns. Known knowns are things that have happened that we know about, and Steve has talked about a bunch of those. The strait's closed. Qatar's LNG facility is shut. We know there's been damage to refineries and processing facilities. in various countries that surround the Gulf. Known unknowns, though, are things that have not happened. Everyone at least knows have yet to be determined, for example, and everyone's speculating about those. When will the Strait open? How much damage has actually occurred at Qatar at the LNG facility? Will China and other oil importers have sufficient stockpiles to avoid a shortage? Will oil producers like the U.S. increase production to address the shortage? And if so, how long can they keep doing it? But the unknown unknowns are events, that may happen, but we cannot even predict what they are or what their impact would be. And like during the Iraq War years ago, it appears we're entering a time when we can expect more unknown unknowns. And obviously, we don't know what they are. An example of a unknown that became known is just a few weeks ago, UAE announced it was leaving OPEC, and not many folks had that one on their bingo card. And there seems to be now a new unknown almost every month, and they can and they will move the energy market. So in thinking about how to prepare for this webinar, I thought, what, this is a time, kind of like a contestant on the game show Who Wants to Be a Millionaire, when I would phone a friend and see if I could get some advice. So I called David Cohen. I went to law school with David, and he went on to head up the Treasury Department's counterterrorism department and then become deputy director of the second highest office in the CIA. And I told David about the webinar, and I asked him, I said, David, hey, with January 2027 oil trading around $89 a barrel, backwardated prices of LNG, and poly market showing like 75% of bettors believe the Strait will be open by the end of the year, is the market assessment correct? Or are current market prices underestimating the risk of a long-term shutdown of the Strait? I think this slide shows you a bunch of the current poly market trades, and they change pretty radically and pretty often. And in short, when I posed this question to David, he agreed with us, and Eric will get into this in more detail, that we think, and when we look at these numbers, that the market is underestimating the risk of a prolonged closure of the Strait. David's, though, reasoning was much more tied to geopolitical events than certainly I can do. And his analysis really went like this. He said, look, Iran's current offer to settle the dispute appears to be unacceptable. Public commentators, we don't know the exact terms of the offer, suggest that includes Iran's continued control of that strait that Steve talked about, their right to enrich in uranium, payment of reparations, and withdrawal of all U.S. troops. At the same time, the United States is rightly reluctant to return to active military operations in the Gulf. I think the main reason for that is that bombing Iran is unlikely to soften the Iranian position and allow a reasonable settlement. So what are we left with? We have the blockade and the hope that the pain it imposes on Iran will cause Iran to change its position. But David believes that a few months of an embargo will not cause Iran to come back to the table, since the current leaders in Iran, to the extent we know who they are, appear to be more inflexible, dug in, and doctrinaire than even their prior leaders. And of course, there's always hope that China will lean on Iran to open the strait, but David thinks that's also unlikely. He actually thinks while China obviously would like more oil from the Gulf, he thinks that Xi will follow a Napoleonic maxim, which is never interfere with your enemy when he is making a mistake. So we'll see. But on the other hand, the current situation, as we all know, can't go on forever, and pressure is certainly building to open the strait. But David doesn't see that happening very soon. And when pushed on it, if he had to place a bet, he said he would go long oil at today's prices. So when you add this geopolitical perspective to our standard market analysis, it seems pretty clear to us that the market underestimates the risk of a prolonged closure of the strait. So while Steve is the person I would certainly turn to guide me through the strait on a destroyer or on a tanker, I'm going to look to Eric Bratcher, who's the person I would look to say, hey, how do I manage my exposure to this current energy market? So with that, John, I will turn.
John,
sure.
Before we head over, I want to remind everybody, if you have any questions, please pop them in the into the Q&A, and we'll try to get to them. One question that came in, John, I don't know if you can say a few more words, is about the effect of what's the potential effect of China in all this, China and Russia, and how those, the competing interests of those two nations might have an effect on what's happening geopolitically.
Yeah, and I think I mentioned, I think obviously China, it's just hard to know. China was certainly is a very large buyer of oil from Iran, and has depended on large supplies of that oil. What we really don't know, as I mentioned, is just how much they have stockpiled and how they look at the trade-off in terms of what's going on in the Middle East and their own geopolitical interests. So, well, I think the president certainly went to China in an effort to get China to put additional pressure on Iran, and I think that pressure could actually have a real impact on what happens in the Gulf. So far, no real progress. So it's hard to handicap, though, at what point or what's the nature of those pressures. Obviously, Russia, I think, is the big beneficiary from all of this because their oil, which was trading at whatever $60 or so a barrel, is now a hell of a lot more expensive, and that's a lot of revenue to help them. But they've got their hands tied up at the same time with the situation in Ukraine. So easier to get into these wars than to get out of them, for sure.
Yeah. Okay, there's got one other question, but I'm gonna save that for later. And Eric, why don't you hop into our markets conversation?
Yeah, so we'll start with crude. Just the crude oil prices, what they have been, and what the forwards are looking at now. This chart is in the blue side, it's historical spot prices, or at least the monthly average of those daily spot prices, and you can see that over the last 20 years, we've seen a decent amount of volatility in spot crude prices. One thing that you can see is right there in late December, early January, we were seeing spot crude prices of below $60 for WTI. WTI is Cushing, Oklahoma. It's our big trading hub in the United States, and that's what this is, Cushing, Oklahoma, WTI. Decent increase over the last couple months, a little bit downturn last month on the average on the progress of the peace talk. The red line is the current forwards, starting with the June contract, trading at about $105. What you notice is there's a very steep backwardation where even though June might be trading at $105, just 6 to 8 months in, the January contract is trading just above 80, like 82, 83. It has a lot of volatility. Which day you draw this line, it may be up or down $3, $4, $5. But that slope, that discount rate is holding pretty constant. And then after that, it trails out pretty similar. The back end of the curve hasn't moved a whole lot. It's mostly the front of the curve that's moved a whole lot over the last couple months. The back end of the curve going out beyond 27 and 28 has probably only moved up $2 or $3 per barrel. The front is where you have all of that volatility. A couple things here. That steep backwardation assumes a relatively short solution to the Gulf opening, and the Gulf opening and prices going back to what appears to be a fairly median price since 2021. If we saw oil back in the $70 to $80 range, that's fairly median compared to what we've seen. It's not as low as what we saw at the of Q4 of 2025, but that was also some of the lowest prices we've seen since COVID. So the market is taking some of that time to replenish SPRs and recover from months and months of taking a very large quantity of oil off the market. But it is fairly discounted and has a fairly optimistic view of the world getting back to normal relatively quickly, both from a price and flow quantities. So that's crude, somewhat elevated, but not super high, not as quite as high as we were seeing in, the early teens when we were looking at crude prices also in this range. Again, none of these prices are adjusted for CPI. This is just straight dollars. Yes, sir.
Quick question here. So what caused the spike in 22?
That's a good question. A large country invaded another one. Russia invaded Ukraine, and there was a lot of natural gas and some oil that was flowing through Russia to Ukraine. A lot of Europe decided to sever their purchasing of Russian crude, and that was a kind of a demand shift in the market where you had massive amounts of countries that were buying crude from one spot and they're not buying it from another one. So that change put more pressure on West Texas Intermediate prices, so it rallied a bit. A shift in demand. This is more shift in supply, right?
But in terms of kind of how people thought how long the conflict would go on, it's exactly what we're worried about here, which is all the markets and the commentators said, look, this can't go on for more than 4 weeks, 6 weeks, maybe maybe 2 months.
Yeah.
And now what are we, 4 years or
4
so?
years. Yeah.
4 years here. So obviously we don't think with the pressure, there's so much that comes out of the strait to so many different countries with the pressure that it could actually withstand that kind of, that could go on that long. But it only takes, if this goes on for 3 or 4 or 5 months, everyone now will predict, like you say, anyone that goes on for 4 or 5 months, you're looking at $130, $150 oil for sure. So that is a known. We know if it goes on that long, watch out to prices.
Absolutely. Shifting from crude to LNG, here's a couple charts of January's futures contract for LNG in 2 of the largest trading hubs in the world. The left one is TTF. It's the Dutch, it's kind of the Northern Europe #1 and largest natural gas trading hub. And then the right one is the Japan Korean marker. It's the Asia's largest natural gas trading hub. So because a ship can go to either one, those prices are typically pretty close in parity, and even now they're pretty close. You see JKM trading at just a slight premium to TTF, mostly because of where that gas was coming from and how easy it is to bring gas from the United States to Europe versus the United States to Asia. It's just a much larger route and takes longer, so the gas is just a little bit more expensive, and as you'd expect. Anyway, all these prices were trading at the end of December at about $10, $9 to $10 per MMBTU, which was some of the lowest prices we've seen since 2022 and Russia invaded Ukraine. Back then, prices for LNG being delivered into Europe got as high as like $45 to $50 per MMBTU in the middle of the summer. So yes, it's elevated. It was, prior to last year, the majority of last year, it was trading at about $12 per MMBTU, got as high as about 20 to 21 in both of these markets, got as low as 14 in the latter half of last month when peace talks were, in vogue. We're kind of taking the news and using up a lot of the oxygen. Since then, the continuation of the prolonged or lack of peace deals or the deals falling apart has caused that price to kind of rally back away from that $14 price that we saw, that low, into the $16 or $17 range with a decent amount of volatility. So this is all to do with the fact that 20% of the world's LNG is no longer flowing out of the Gulf. So the market is trying to assess how is that natural gas made up, and how do we, since we're in the summer and we're replenishing our natural gas storage, how does that storage look? How much natural gas is Europe and Asia and the United States going to need to put into the caverns, the storage facilities, to make up and have an adequate amount by the time we get to next winter? So when the market looks at those, we look at storage levels for the United States. These are, if you've been on any of these webinars from any energy analyst, you've seen the chart on the right, maybe a different version that shows a gray range instead of the lines, but you've seen something like that 1,000 times. Europe has a very similar type structure, right? So all of the natural gas values in Europe equate to about 4,000 BCF in a very similar manner that the United States has. Right now, the United States is about right in the middle of that 5-year range. 2024 was the year that we had the most storage at this time. 2022 was the year that we had the least. And then right now, we're kind of right in the middle, almost exactly in line of where we were last year at this time. On the left, the European storage numbers don't look nearly as optimistic or closer to the median. Their storage levels are a lot closer to 2022 values and actually not increasing as fast over the last few weeks as we saw in 2022. So they are definitely further behind the 8 ball than we are in the United States, which is going to continue to put pressure on where is Europe going to buy that natural gas, and are they competing with Asia to buy that next shipment full of LNG to make their storage levels closer to that 4,000 by the time they get to the end of November? So there's definitely a competing market for LNG, both in Asia that depends on the gas a lot, and in Europe, who is looking a little bit behind the eight ball for natural gas. What's this doing to natural gas prices in the United States is where we're about to go next. There's kind of a bifurcated market, or two different sides of the coins of the one coin, two different sides of the coin of what elevated LNG prices and natural gas prices do to the United States. The United States only has one major import terminal for LNG, and that's in Boston. And Boston relies on that LNG imports because they have insufficient pipeline capacity in the middle of the winter to bring enough gas to run their natural gas fired generation and for space heating and all that kind of stuff. So in the middle of the winter, the price of natural gas in Boston Harbor and in New England is really set by the price of LNG because it's the marginal cost that's being shipped in to meet gas demands on those coldest days. And this is the chart for January's contract for Boston's gas. And if we were to overlay it with that LNG chart we just saw, you would see a direct correlation where in February, we had some cold in late January, so you saw a move of Boston's gas for next winter that was trading, pretty close in line with LNG, jumped up to about $16 based on the congestion. And then right at the invasion, when LNG jumped up to about $22, so did the price of gas being traded in Boston. Then it sold back off down to about $16, $17 when we were all talking, again, peace was prevalent. Spiked back up to 20 and is now trading at about $19 per MMBTU for gas being delivered to Boston. So very similar story. It's moving in the same magnitude and the same direction as the price of LNG. So as you think, Northeast winter gas absolutely tied to the price of international LNG. Looking back to what that looked like back in 2022, when we had a similar volatility in LNG prices, the January 2023 contract is plotted here in blue, and you can see how that volatility and the highs that we saw in the middle of the summer of 2022 compares to the current market price for next winter. There was a lot more volatility, a lot higher. It was the first time that the world who became accustomed to consuming LNG had a kind of a demand shock or a supply shock if you were in Europe. And the international price of LNG was absolutely impacted. And really, when we were just at the beginning of the war, the prices elevated to prices similar that we're seeing now in the high teens to low 20s is kind of what we were seeing in the first month and a half of the war. And then as that war escalated and continued to carry on as we went through the summer, you saw that continuation of price escalation all the way up to about September. And then you started to see a decent fall by the time we got to the latter half of the year as increased LNG prices, LNG quantities, and weather actually was just helping out Europe quite a bit. It wasn't until after that winter where the United States and Europe had a very mild winter that LNG prices went kind of back to normal.
So Eric, this seems to suggest that the reaction, there's clearly a reaction post hostilities in February. It's not nearly as bad as it has been historically.
Absolutely. Yeah. The price of gas in the Northeast, went from about $17 to about $19. Prior to the invasion, it was $16 or $17, and now it's about $19. So $2, it's, a little bit more than a 10% rally in market prices. So not nothing, but not nearly as volatile as we saw in 2022. So that's the market saying, we're assuming that this thing is going to get better relatively quickly, and the incremental demand from Europe and Asia isn't going to cause LNG prices to continue to escalate like it did in 2022. Fairly optimistic viewpoint. Moving to the price of gas in Louisiana, both for the winters and the summers. The blue and black line is the price of gas being delivered for the summer. The blue line is the summer and the black line is the winter back in 2022 in Louisiana. Louisiana, because that border right there where Henry Hub is right, kind of just east of the border between Louisiana and Texas, where a lot of our LNG exports are centered. You saw quite a increase or rally in LNG prices back in 2022 based on the increased demand of those LNG terminals. And we had a decent winter in the winter of 2022. So we were, again, below end of our storage, but so was Europe. We saw a lot of volatility. This drop right here in the middle was when Freeport's LNG terminal caught on fire and shut down. So you saw a rise in LNG and a drop in Louisiana prices. You compare that to the next summer or the balance of 2026, the green line, and this coming winter, the gold line. Right now, the price of gas in Louisiana for the balance of this injection season is the lowest prices for that time frame that we've seen since 2022. So the exact opposite reaction that we saw back in 2022. Prices for the balance of this summer for gas in Louisiana, relatively inexpensive, and it looks like over the last few days have been bouncing off that $3 kind of floor. Prices for this winter, December through February, also are kind of hitting the floor that they saw just before we saw a lot of this cold winter. You saw a low price for that strip the middle of January before we knew Winter Storm Fern was a thing, when it was trading at about $4.20, $4.15. Right now, we're trading just a few cents above that low price that we saw in January. So volatility in the Northeast because of LNG's kind of setting the price of gas being delivered into Boston, yes, slightly elevated, 10 to 15% elevated compared to prior to the war. For the cost of gas in Louisiana, nothing like we saw in 2022. The exact opposite is happening. We're seeing some of the lowest prices that we're seeing for those two strips going back really all the way to 2022. So,
Eric, I mean, what do you think?
Yeah.
What do you think explains that? I mean, it just seems like this market is trading counter to just what is common sense. I mean, we're at prices that are kind of the bottom of where they're likely, not the absolute bottom, but close to the bottom of a trading range with all this upside risk.
Yeah, I think the reality is our LNG terminals can only go so fast, and that increase in demand does not necessarily mean an increased supply coming out of the Gulf. LNG exports over the last few weeks have been actually down, mostly because we're entering maintenance season for a lot of these things. It's, April and May isn't a big LNG export month, so some of the values on a day-to-day basis of the amount of gas that we're liquefying and selling to the rest of the world is actually down a bit from a month ago. Production is strong. We're starting to see, because of the increased price in crude, an increase production of natural gas coming out of Texas and West Texas. So that increased kind of production of natural gas is also oversupplying the Texas and Louisiana market. That's also having an impact on basis prices, or how cheap we're seeing prices in Texas for natural gas. We saw some of the extreme negative prices for natural gas out in West Texas that was having an impact on the price of gas all the way into East Texas and Louisiana. So you're seeing some of that massive demand for oil and increased production coming out of West and East Texas that's putting downward pressure on Louisiana, even though we're not seeing as much downward pressure in other parts of the country. So it really is kind of like an oversupplied Texas market of gas.
Question just came in. I know you're probably going to get to this, but what is the effect on power markets?
Good question. So moving into those power markets, starting in places that have the highest correlation to LNG, like Boston, we're seeing a reaction for this winter. The black line follow those prices of LNG almost directly, right? So the price of gas, price of electricity for Boston's winter strip, this next winter strip, November through December, prior to this event happening, was trading at just above $110 per megawatt hour. The height was about 150, sold down to about 120, cut back up past 140. So lots of volatility, but currently trading in the 130 to 140 range. based on the volatility of that LNG market, international LNG prices. Next winter, slightly elevated, but really in line with what prices were for this winter prior to anything happened. So elevated, but not a lot. Maybe $10 higher than what we saw just before the war for the winter of 27, 28. For the non-winters in Boston, up slightly, but not up materially. They're still cheaper than we saw back in the fall and the vast majority of Q4 for the balance of this summer and next summer as well in Boston. New York, it's almost the exact same price. A slightly discount for all of these terms compared to Boston just because they have access to a little bit more natural gas in the winter, but direction and magnitude change for New York City prices almost identical, and power prices for this summer and next summer really following the volatility of natural gas in a way. So relatively inexpensive for the summer gases, for the summer prices, because of that cheap price of gas in Louisiana and the discount in the short term. The winters are elevated and following LNG prices. The further you get away from Boston, this is PJM's West and East hub. I put West and East because they're pricing at almost parity these days. The winter lines, the black and the gold, are elevated, and they were trading at about $72 prior to this invasion, and now they're about 80. So you saw about a 10% rally in prices for the winters. The prices for the summers are up slightly. Instead of being the median, they're kind of on the upper end of their trading range, but that has a lot more to do with all of the other things going on in PJM, like market reform, killing the capacity market, maybe contemplating PJM falling apart when you have the FERC and the PJM kind of butting heads these days. So lots of turmoil in PJM, not nearly as driven by the price of natural gas being imported into Boston because of it's just farther and farther away. But a little bit of volatility, still, slight premiums to those markets compared to what we were seeing. And then ERCOT in Texas's market, the exact opposite. Just as you might expect when we're talking about natural gas prices being very cheap and having negative basis prices in West Texas, ERCOT's power prices, not only because of fuel, but other fundamental things going on in the ERCOT market, has really fallen. It was starting to fall just in early January. You started to see a market that for the first time in a while was starting to correct itself to the downward side, and has continued to fall all the way up until about a month ago. You started to see it kind of bounce and move up just a little bit and kind of hit its floor. But the power prices in ERCOT are the cheapest we've seen since the fall of 2024, which 2024 was the cheapest annual price of LNG, for prices of gas at Henry Hub since the contract became available, since it deregulated. So relatively inexpensive prices in ERCOT, as you would expect with cheap fuel and good market fundamentals. So no marginal impact in ERCOT or really anything that's farther west than PJM in the energy markets.
Good.
Moving on.
Yeah. So I think this is just to kind of summarize our observations and recommendations. You can see as Eric was talking about, the reaction is very, very different based on where we're talking. The reaction to ERCOT is completely different from New England. And the key question, the key unknown is how long is this thing going to last? Right. If the answer is 2 to 4 months, it's very different than if it's a 12-month problem, a 24-month, or a 4-year problem, which it'll be a very, very different dynamic. But right now,
the market is kind of assuming it's a relatively short-lived problem.
Right.
If you're just looking at values and upside risk versus downside risk, where the markets were for LNG or power prices in the Northeast prior to the elevation of LNG prices, and then where they are now, even with taking 20% of that LNG off the market because of the Persian Gulf, and storage values in Europe being some of the lowest they've had since 2022, when we were seeing $20, $30, $40, and $50 LNG prices being delivered into Europe. Right now, that premium is only $3 or $4, maybe even $6.
I think the lesson learned, I think, for energy buyers right now is that there is so much more upside risk, uh, and that versus when you consider what the downside potential is, there is a tremendous amount of upside risk depending upon how long and what the duration of this thing is. As you can see, when Eric showed that slide around natural gas in Algonquin, I mean, it could get a whole lot worse, and it can probably happen pretty quickly. That's probably the biggest risk here, is that there can be a very big movement. It can happen in a very short amount of time. So our advice overall is, if you're looking to make purchases, do it now. Especially if you've got open positions this winter. Now is really the right time to start taking some of that off the table. Sorry, John.
Those are the ones that look particularly, ideal. It's elevated in December and January for sure, but it still seems discount. It seems like it's trading well below where it should be, given the uncertainty around the situation in the Gulf, and that's it's rare to see it looking that clearly. And I think we are starting to see more commentators. I think Bank of America came out with something today saying, we don't see oil prices below $90 a barrel, no matter what. So if that's the floor, not a bad time, to hedge, because it can only go up from there.
See if we got any, there's a couple of questions, Eric. I think that's our next slide, right? Questions?
Sure. Yep.
So one question that came in is, if this doesn't end soon, so in looking at the different power markets, clearly Boston is trading very differently from ERCOT. If this doesn't end soon, do you see that reversing itself, where ERCOT does start to follow and look more like Boston and New York ISO?
Yeah, I think it's, it seems the natural gas market, the price of gas in Henry Hub, is bottoming out. Like the last few trading sessions, June has been rallying, and it's rallied significantly, materially. So a rising natural gas market, it's going to be hard for even a market like ERCOT to sell off, to continue to go downward, be bearish, if natural gas prices start to rally. It's fighting against the tide, right? Moving upstream is kind of the fight, and that takes a lot of bearish sentiment in the short term to overcome a rising natural gas market. So a rising gas market for Henry Hub or all of those other kind of non-Northeast markets is going to put upward pressure on all markets. Natural gas is still the marginal fuel that runs the marginal power plant in the vast majority of the deregulated markets, so a rising gas price is going to be hard to overcome. LNG in the Northeast, and the Northeast is really PJM East, everything north of New Jersey, everything that kind of touches Transco, which delivers gas into Algonquin, everything that is associated with Transco, probably Zone 5 and north, is at risk of a rising LNG market. And I think it's very easy for the LNG market to be $20 to $30 within a month or two, if this continues. It seems right now this very small amount of premium, both Asia and Europe are okay with waiting this out just a little bit longer before they start getting in a price war to buy the natural gas to fill their storage values to make it through the winter. It won't be very long in the summer before those buyers start getting a little bit more anxious and trying to outbid one another to buy that next marginal ship.
Hey, Eric, we got probably time for one more question here, and one came into the chat here. Can you say a few words around the risks to our domestic storage levels? What are some things and some factors that could contribute to depleting our own inventories and pushing prices up into the fall?
Yeah. The market already has a significant premium for this winter compared to the summer, right? So there's over $1 difference. There's about $1.50 difference between the price of gas in June and the price of gas in January. So that storage premium is already a lot there. We're starting to see that come in a bit, with June trading up and January not moving so much. The winter's kind of staying solid and the front moving up to it. So that's the market trying to assess what, how much gas do we have now versus how much gas we're going to have at the end of injection season. But if we have a warm summer and we have a decent amount of consumption, or if oil stays high and we have a hard time getting gas out of West Texas because of congestion and pipeline constraints, then we could see natural gas prices rally at least another 50 cents. It wasn't those gas prices that are looking very inexpensive could easily rally another 50 cents, maybe even $1 in a relatively short amount of time, just based on increased demand and weather outlooks and really all of the economics around it. Probably the only thing that's really bearish in this market compared to, given where these prices are, is economic fear, recession fear. When you start to have prolonged high energy prices, and there's just a lot of economic signals right now that are looking a little bit bearish. Unemployment, inflation, all the kind of things that go along with high energy prices start to have, increased inflation, increased interest rates. All those are kind of bearish to economies and that kind of stuff. So that's probably the biggest bear on the horizon, is just how does the global and the domestic market react to oil prices that are relatively high and could possibly raise to $130, $140. We will start to see economic impact because of that.
I would add that we haven't talked too much about the other big bull in the room, which is AI demand. And anyone who saw what NextEra offered to pay from Dominion yesterday will know that there's no shortage of interest.
It's a hell of a bet.
Interest in the additional generation that'll be needed to meet data center demand.
So just add that to the pile.
Yeah.
All right. Well, we're at time here, so we thank you very much for your time this morning. We thank you for joining us. If you have any other questions, make sure you reach out to your 5 Energy advisor, or you can get a hold of us through this email address here on the slide. Thank you again for joining, and I think the thing we have to just kind of keep our eyes on, and even though it's hard, is this. It's, as John said, is those unknown unknowns. As we were getting ready for this webinar this morning, we were just doing a quick check of the news to see if anything popped up overnight, because that seems to be the operative concern here. Is on any given morning something could show up that moves these markets in a very different direction. So I don't know, John, Eric, we may end up doing.
Or just during this call.
Yeah, during this call. Yeah. So thanks again for being with us this morning, and we hope you have a good day.
Thank you.
Thanks for your time.